Paper gold and silver just crashed on the screen. And the internet is doing what it always does in moments like this. People are calling it the end of the rally. People are calling it proof that precious metals are a scam. People are calling it a signal that inflation is dead and the dollar is king again. But the real story isn't the candle. The real story is the split. Because while paper prices can drop in minutes, physical markets don't move at the speed of algorithms. Real metal doesn't teleport. It gets refined, shipped, insured, vaulted, and paid for with real cash. And when paper and physical stop agreeing, that's not just volatility, that's structure showing its teeth. So here's what we're doing today. We're going to separate what happened from what it means. We'll break down why paper, gold, and silver can fall violently even when real-world demand stays firm, how forced selling works like a trapdoor, why premiums and availability often tell a different story than spot, and the 4 signals that will tell you whether this move was a shakeout, a regime shift, or the early phase of a larger repricing. And I want you to keep one sentence in your head from the start. In precious metals, there are 2 markets. One trades claims, the other trades ounces. When they disagree, one of them eventually blinks. Section 1. Let's start with the paper market, because that is where the crash prints first. When you see gold or silver drop fast, the instinct is to look for a macro headline. The Fed said something. A jobs number surprised. The dollar popped. Yields moved. Those things matter over time, but the fastest moves are usually not a change in belief. They're a change in positioning. The paper market is built on leverage. Futures contracts, options, swaps, and margin-based exposure let traders control a lot of metal with a relatively small amount of cash. That leverage is powerful on the way up, but it's brittle when conditions tighten. And conditions tighten in 2 main ways. Price volatility spikes, and the cost of carrying exposure rises. Here's the mechanism in plain language. A futures contract represents a large quantity of gold or silver. You don't pay the full value. You post margin, a fraction of the notional value. That margin is a performance bond. It's the exchange and your broker saying, prove you can survive the next wave. When volatility increases, exchanges and brokers often raise margin requirements. Even without an official change, brokers can tighten risk controls, adjust house margins, or reduce the leverage they'll allow. The result is the same. The trader must post more collateral immediately or reduce position size. If they can't, liquidation happens. Not because they changed their mind, but because they ran out of room. That's why these drops look like cliffs. In normal selling, people choose to sell. They scale out. They wait for levels. They negotiate. In forced selling, the seller doesn't have a choice. Stops get triggered. Stop orders become market orders. Market orders hit thin liquidity. Thin liquidity exaggerates the move. The move creates more margin stress. More margin stress forces more selling. That loop can turn a routine pullback into a waterfall. Gold and silver respond differently because they are different animals inside the paper system. Gold is deeper, more liquid, and more widely held as a monetary reserve asset. Silver is smaller, more thin, and more explosive. Silver can be crushed quickly when leverage is flushed because it doesn't take much forced selling to overwhelm bids. And because silver is thin, it can also rebound violently when cash buyers step in. So if you watched both metals drop and you thought this feels unnatural, that's because it is. It's a leverage purge. The paper market was clearing risk. The chart was the casualty. Section 2. Now let AS move to the part most people don't understand until they live through it. The physical market can tell a completely different story at the exact same time. Physical gold and silver are not just spot plus shipping. The physical market has its own constraints. Refinery throughput, mint capacity, wholesale inventory, logistics, insurance, and dealer risk. Physical supply can be tight even if paper price is falling. And physical demand can surge precisely because paper price is falling, because real buyers see a discount. This is where the split appears. The screen price prints lower. Headlines scream, social media panics, and then you check the real world. Dealers aren't cutting prices the way the chart implies. Premiums aren't collapsing. Certain products aren't available in size. In some cases, dealers slow down sales or widen spreads because they can DT hedge inventory cleanly during violent paper moves. The result is that the price becomes 2 different things. Paper price is the benchmark number created by contracts and claims. Physical price is what you actually pay to secure actual metal. When those 2 drift apart, you get a dislocation. A dislocation is not a conspiracy theory. It's just what happens when the instrument setting the benchmark can trade in huge size without requiring immediate movement of the underlying metal. Paper claims can be created and traded at speed. Physical ounces cannot. That gap in speed and settlement is the source of the mismatch. And here's why it matters. If the paper price drops far enough below physical reality, the discount becomes bait. Real cash buyers step in. End users who need metal for manufacturing lock in supply. Deep pocket accumulators take advantage of the mismatch. Arbitrage participants look for ways to buy where it S cheap and sell where it S expensive, even though financing and delivery rules can slow that process. The split creates pressure for resolution. But the resolution doesn't always happen instantly. The physical market is slower, and the paper market can stay distorted longer than people expect. That's why your job is not to assume the chart is truth. Your job is to track whether the physical market confirms the move or rejects it. Gold and silver have different physical dynamics as well. Gold's physical market is heavily influenced by central bank activity, jewelry demand, investment bars, and cross-border flows. Silver's physical market is influenced by industrial demand, fabrication cycles, and the fact that much of its mine supply is produced as a byproduct. That byproduct nature means supply doesn't respond quickly to price. If silver doubles, mines don't instantly double output. The pipeline is slow, so in both metals, a paper crash can happen without a fundamental collapse. And in both metals, the split between paper and physical is where the real story starts. Now, let's talk about why this split keeps returning and why it matters psychologically. After a paper crash, you will hear instant certainty. You'll hear that the rally was fake. You'll hear that precious metals are finished. You'll hear that smart money sold and the little guy got trapped. Certainty sells in chaos, but certainty is usually a costume. What happens after forced liquidation is a transfer of control. Leveraged holders, the weak hands, get flushed. The market hands exposure to those who can survive volatility. Cash buyers, longer-term holders, institutions with collateral, and end users who need ounces, not opinions. This is why a crash can be both terrifying and constructive. Terrifying because it's violent. Constructive because it clears fragile positions that can be forced out again. That doesn't mean price immediately moons. It means the composition of holders changes. And composition matters because the next move is determined by who is left. If the move was driven by leverage, then the next chapter depends on whether leverage is gone and physical demand remains. If physical demand stays firm and inventories continue to tighten, paper has less room to push price around forever. If physical loosens and inventories rebuild, then paper weakness may be reflecting a real cooling. There's also the macro layer you cannot ignore. Gold and silver are sensitive to real rates, dollar liquidity, and risk appetite. If the Fed is tight, if the dollar is rising aggressively, if funding markets are stressed, paper pressure can persist longer than the physical market wants. That is the environment where dislocations can widen before they resolve. This is the trap that destroys people. They can be right on the long-term thesis, but wrong on timing. And leverage makes timing fatal. The paper market can force you out before you're proven right. So here's the practical lesson. If you trade leverage in precious metals, your enemy is not only price, your enemy is mechanics. Margin, volatility, liquidity, and broker risk rules. If you do not have slack, you do not have a position. You have a timer. And if you're not leveraged, if you're physical or long-term, your job is different. Your job is to read whether this was a structural flush or a true shift in supply and demand. That's where signals come in. Let's end with the 4 signals that matter most when paper and physical diverge, because these signals are how you stop being surprised. First, premiums and real-world availability. If paper price falls and premiums hold, that's the physical market refusing to validate the crash. If premiums widen and inventory tightens, that is often a sign that real buyers are absorbing metal. If premiums collapse and sellers undercut each other, that is confirmation of real weakness. Don't guess, watch the behavior. Second, inventory levels at major warehouses and exchanges. Ignore rumors and focus on ounces. Are stockpiles draining, stable, or rebuilding? A market with draining inventories is a market where paper distortion has limits. A market with rebuilding inventories has cushion and paper can dominate longer. Third, delivery and settlement behavior. Futures are claims until they meet delivery. Watch whether participants stand for delivery, whether delivery demand rises, and whether settlement behavior changes. This is where paper meets reality. When delivery stress increases, the paper benchmark has to respect the underlying. Fourth, regional price alignment. If gold or silver trades materially higher in one region than another, it creates a gravity field. Metal tends to flow toward the highest bidder, subject to rules, taxes, financing, and logistics. Persistent regional premiums are a message that the real market is bidding differently than the screen. Now put those together with one final contrast, because this is the mindset shift that separates amateurs from pros. Amateurs think price equals truth. Pros know price can be pushed by structure, especially in markets where leverage is heavy and liquidity can thin out quickly. Gold and silver are exactly those markets. So here's the clean summary. Paper, gold, and silver crashed because the paper system tightened and leverage got purged. That purge can produce cliffs that look like fundamentals changing, but fundamentals don't change in minutes. Mechanics do. The physical market may or may not confirm the move, and your job is to track that confirmation through premiums, inventories, delivery behavior, and regional alignment. If you want to interpret the next move correctly, don't anchor to the loudest candle. Anchor to the split, because when paper and physical disagree long enough, one of them has to blink. And the moment it does, the move won't feel slow. It will feel inevitable.